In managing through difficult markets, there's a phenomenon that I don't know any better way to describe it than sell low and buy high. And in fact, I've had many conversations with people over time, and they've said, I simply have never had a good experience in the market. I've been investing in the market for years and years, and I just don't believe these figures about the growth of equities over time, because that's never been my experience. And in fact, in my own case, I joined this business in 1984, and I remember quite well my first experiences in the business. First off, when I joined in 1984, the Dow Jones Industrial Average was somewhere around 1,000 points. And today the Dow Jones Industrial Average is about 13,500. So if I'd known back in 1984 that my job was really to take people, get them to buy a diversified portfolio of stocks, and then ignore the media and all of the cries about Armageddon that were about to erupt in every bear market that happened since, then everybody I met in 1984 would have 13 times as much money as they did back then, or as they had invested. But what gets in the way is that investors, we often buy fads and guesses as opposed to something reliable. And in fact, we very rarely ask ourselves, is this the most reliable way for me to get exposure to the market, as opposed to what's best? And I'll give you an example. Back in the 50s, we all remember the tech bubble of 2000. Well, maybe not all of us, but most of us remember the tech bubble of 2000, where tech stocks became the darlings. And if you were buying tech stocks, you were a genius. You were earning 30, 40, 50% on your money, sometimes a multiple of that. And everything seemed to be great until tech stocks, of course, suffered an inevitable decline. And many of the investors lost a great deal of money, in fact, more than their original capital if they had been borrowing to invest. And this bubble phenomena repeats itself over and over in history. If you go back to the 1950s, there was a bubble in bowling stocks. Now, as strange as that may sound to us today, you'll notice that there's a lot of bowling alleys in most cities, and they all date from the 50s. And there was an explosion in bowling. The popular thought of the day was that bowling stocks were a can't-miss thing. People had young families, they were going out, they needed recreation, so it fed on it. The bubble fed on itself, and whether you were making bowling shoes, bowling lanes, bowling apparel, if you're a publicly traded company, your stock went through the roof. So people piled on that bandwagon. And of course, there have been similar bubbles throughout. There was gold stocks, there were tech stocks, and so on. Most recently, we've had the scares around peak oil, and people were buying up oil stocks at any valuation. And if we stop to ask, rather, is this the best thing, or should I get on this train, and instead ask ourselves, what's the most reliable way to capture what the market can do over time, I think we'd come up with very different answers. So in terms of how do you approach managing your equity portfolio through difficult times and through things like bear markets, the first thing is to assemble a reliable portfolio. So not necessarily the portfolio that's going to shoot the lights out. You don't need that. The growth of the market will take care of it. We need to ask ourselves, is this the most reliable way for me to get to my objectives? Take the predictions of economists around things like the market, and you take a look at track record over time, you see that their guesses are no better than random chance. So in fact, one of your jobs in the course of a bear market, if you're looking to navigate bear markets successfully, is to ignore all of this noise that's occurring during bear markets and look back at the tremendous growth of the market over the long term, and know that the next bear market, and if you're looking at a 30-year retirement, you're going to go through another 5 of them, is that the next bear market is going to end just like the previous 13 since the Second World War has ended. In this slide, we've got a quote from Peter Lynch. And if you remember back to a previous segment when I was discussing an entrepreneur whose strategy was to sell all of his portfolio when things looked bad and buy it back after when things had stabilized, is that Peter Lynch Its quote is, "Far more money has been lost by investors preparing for corrections or in trying to anticipate corrections than has been lost in the corrections themselves." And what he's referring to here is the fact that when you're selling out your portfolio, ostensibly the evidence you've accepted for the reason to sell your portfolio is the market has gone down. So you're selling it out, and now you're looking for evidence that the market is going back up. Well, of course, the only evidence that will convince you is the market has to go up, and not only go up a bit, but go up in a sustained fashion that you're convinced that, okay, the worst is over. Now, what the effect of that is that each time there's a sale, there may be a tax consequence, but there's certainly a wealth consequence in that it's unlikely you're buying back your portfolio at the same level you sold it at. So it's important, again, in a bear market, through all the noise that we hear about how it has to be sold now, that things are just going to keep getting worse, and so on, is that we put that on the back burner and that we have faith that this bear market is going to resolve itself the same way every other one has. I'd like to conclude this series of videos with 3 ways to immunize yourself against the risks that we face, both in accumulating a significant amount of capital to fund our retirement, and then managing that capital through our retirement to defeat the risks that we face, which are both volatility and inflation. And the first one is that against inflation, own stocks. And by owning stocks, I mean owning a reliable portfolio of stocks. Not buying the fads or the hot stocks of the day, but in fact buying a portfolio that is diversified both by geography. So for example, it's an international portfolio, not just necessarily a Canadian portfolio, and that it represents all the different parts of the economy. So you've got stocks that are commodity stocks, you've got consumer stocks, you've got industrial stocks, and so on. So you've got a broad, reliable portfolio that's going to grow over time. And of course, stocks aren't the only way to defeat inflation. So you may, as an investor, prefer some other growth asset. The important thing is to defeat inflation over time, you need growth. The second way to immunize against the risk that you face in your retirement and in your accumulation is dealing with bear markets. So bear markets, if we go back to the segment on bear markets and we look at the history of bear markets since the Second World War, you'll see that the longest bear market lasted about 3 years. Now, when you're in your retirement and you're concerned about preserving your capital, you want to make sure that if a bear market shows up and it's a long and intense bear market, that you're not liquidating your stocks at unfortunate low prices. And in fact, you want to hold those stocks through the bear market. But one of the things that makes it very easy to do that, well, easy is probably too strong a word, less painful to do that, is if you have money set aside to take you through those 3 years. So you want to own at least 3 years of fixed income or cash. And then that way, when you're in a bear market, you're taking money out of cash or fixed income to get you through that time period until you're on the other side of that bear market. And I say at least 3 years, preferably 4 or 5 years. And the last key to managing your portfolio through a long retirement and through market risks is your behavior. And this is a big one. Don't sell in bear markets. And it seems simple. It seems like a simple maxim to follow, but it's very difficult. And in fact, it's what defeats most investors over time. And for people who don't believe that, all you need to do is take a look at the inflows into equity mutual funds. Equity mutual funds, the inflows are always at their peak, at the top of market, and record amounts of redemptions are occurring at the bottom of the market. And in fact, if you look at bear markets and you find the absolute bottom of the market, you will also find the peak in equity mutual fund redemptions. So in fact, all of those investors are compromising themselves and compromising their future retirements by liquidating at those points. So these 3 things are the keys, in my opinion, is that we need growth investments to defeat inflation. We need to own in our retirement sufficient amount of cash to get us through difficult markets. And finally, we need to think in advance about how are we going to behave when markets don't go the way we want them to. Thanks very much for listening. I wish you all the success.